The Northstar SCI managed fund had a solid absolute quarter, did just over 10% return. This wasn't quite up to scratch against the peer group, but year to date the fund is a top quartile performer, and it's ahead of the peer group over 1, 3, 5 and years and longer periods. So it's doing exactly what we wanted to do. It's quite a conservatively managed fund, and that does tend to cause it to lag a little when you have extreme movements on the market like we've seen in the last quarter. The CAPS was up 22%. We've also saw property up over 20% in the last quarter. Year to date, property is down 37.5%, and the CAPS is down 11%. So over a 6-month rolling period, the fund's done extremely well. It's just lagged a little bit over the last 3 months. Of particular importance to us was in terms of what we have done well. We've been underweight South African equities almost consistently for quite a long period of time now. Again, year to date, same story, underweight South African equities. That worked really well in the first quarter of the year, less so in the second quarter of the year. We've been long offshore assets, and that's worked very, very well. If you look at the MSCI World in rands, that's up 17.4% year to date, which continues to buoy the fund. We've also had quite a lot of fixed income exposure on the shorter end of duration, which has been the best part of the curve to be in. If you look at long duration assets on the curve, they've actually delivered negative returns year to date, yet the Orbi's up 0.4, and we've been right on the shorter end to middle end of the curve, and that's worked extremely well with a lot of yield pickup in the fund. So we've had Orbi exposure or fixed income exposure in place of cash. We had a lot of offshore exposure, quite short of South African equity exposure, and that clearly paired our performance in the second quarter of the year. So we did, in terms of asset allocation, we did what we felt we've done the right thing in the fund. I think one of the other big pluses is just our stock selection. When we run our attribution every month, we can clearly see that just month on month we're very good stock pickers. Less so in terms of sector calls in the last few years with resources running as hard as they have. It's been a tough place for a quality manager as those cyclical stocks rally. And if you look at the second quarter of the year, resources did 42% versus the CAPS at 20, just over 21. So clearly a tough place not to have a large amount of resource exposure in the fund. So stock picking continues to be a key theme for us. To keep up with the markets, we really have to pick stocks well when you're seeing such a big part of the market, 26% of the index, basically running as hard as we've seen with resources. Just in terms of some of the things that really worry us about the markets at the moment, we think that price discovery is a big concern in the markets. We've seen a lot of fiscal stimulus in the system, a lot of monetary stimulus in the system. So if we look at just the extent to which fiscal stimulus has poured into the global financial system since COVID, it represents approximately 4.5% of G7 GDP. And that's more stimulus than we saw in the GFC. And that's all happened in a very, very short period of time. And we think this is having a massive impact on risky assets and buoying prices and removing price discovery altogether. We're also very concerned about fiscal deficits in the G7 and in the emerging world. We're looking at large deficits that have to be funded, and the market scrutiny around that at some point we think is going to lead to a lot of pressure on the markets. If we look at public debt to GDP at the moment, it's going to exceed 100% in the G7, and it's going to exceed 60% for emerging markets. These are levels we last saw in 1943. So, the point we're really making is that investors need to be aware that at some point this kind of stimulus, both from the monetary and fiscal side, will have to leave the system. And can the markets and can economies stand on their own feet in that situation? And we're very concerned that asset prices have run well ahead of the underlying real economy. So a big concern for us, something we're watching very, very closely, and we sense that at some point in time, the kind of conservatism that we apply in our fund is really what's going to count in the environment we forecast in the year or two ahead. So funds well positioned. We think the asset prices are underpriced according to our buy list. We're very positive about the stocks we hold. They're long duration, quality businesses that pump cash flow, good management and high returns on capital. And we really believe on a consistency basis that's the kind of security that you should be having in portfolios, particularly now during a high risk period.